want to welcome everyone for joining us on the 2022 Westwood Wealth Management Outlook Breakfast. Uh, Thank you for joining us early in the morning, and thank you for your flexibility as we continue to adjust and navigate COVID-19. This morning, we welcome Adrian Helfert, Westwood's Chief Investment Officer of the multi-asset portfolios. Adrian is going to share his perspective on the capital markets, our current financial conditions, and hopefully what we can expect this year and into the future. So, Adrian, thank you very much for joining us today.
Great, thanks for having me. Thanks for taking your time early this morning. I wish we were doing this at the Dallas Country Club where you'd be having breakfast and I could walk around on a stage, but next year, hopefully. So appreciate your being here. Just to kind of kick it off as well, we'll do a survey afterwards that we'll send out and just ask a couple of questions around the capital markets. Be interesting to see where the broad consensus comes out for what our expectations are. I'll give you an idea of what I think, but we'll also circulate how the broad consensus is thinking afterwards. And of course, there's prizes that the top participants that win the prize by the end of March, we'll have some prizes for that. Just to kind of kick it off, I termed this, there goes the punch bowl. We often talk in capital markets around the central bank, and when the central bank decides to raise rates, it's because they view an environment that is doing very well, potentially frothy, potentially they just need to put more so-called bullets in the gun to be able to control the next recession. That's pulling the punch bowl from the party. We've had an extraordinary run here. We'll talk about that. The question for us for this year, for next year, is going to be, will that party keep going, or are we going to see a retrenchment? Is the Fed going to overdo it and constrain economic growth? Just setting the stage for where we are. A lot of colors on the page. We call this the Quilt Chart. The broad takeaway here is that we often talk about, gosh, it's been an amazing run since COVID, but actually it's been an amazing run for the last 13 years. The average return and about the median return of the S&P 500 is around 16%. That contrasts to around 10% on average for the last 20 years. On a compounding rate, that's been an extraordinary run for capital markets, for investors that have been invested in this, and it's been driven by the party has just kept going by the central bank. The central bank has been lower for longer on their base rate. We have had concerns around employment, we've had concerns around economic growth and low inflation. Many of those concerns are gone away from the central bank. They are potentially going to be rising rates, likely going to be rising rates. And so that leads to our questions. Some of the other stuff that if you take away this presentation and look at it are just interesting to see is it's a rarity to see where the commodities are doing so well, yet emerging markets are not doing so well. We've seen several instances of this where they're exactly the reverse. The emerging markets are well known as the rentier nations, or the nations that are generally exporting or sitting on vast quantities of oil. In contrast, of course, they're doing poorly at the same time that oil has been rising in price dramatically. That's something we think may reverse in the future, and it's a takeaway from this. Just digging it a little further at that average return, the last 13 years, as I said, have been extraordinary. There's been only 1 year in the last 13 years that have been a negative S&P 500 return. That was 2018, all driven from the fourth quarter, really, of 2018, where, guess what? We were looking at concerns of the central bank rising rates a little further than the capital markets were appreciating. We're in that same observation phase now. Our antennae are up as far as how far they're going to go. I thought this was an interesting chart on a dig-in of the average 13-year return trailing. We're about the top end of that range, and we're still very much in a cyclical environment, which means we've only had one negative year in the last 13 years. This is not an average that is an even keel. We see strong markets until we see a strong retrenchment. That's something we're cognizant of. We think this year will be a reasonable year. We see positive absolute returns, but as I said, our antennae are up for how far the central bank is going to go. And at some point, we could see ourselves back in a market financial conditions off standpoint. We don't think it will be this year. Some of the catalysts that are this year, that are observation points. Of course, I'm an ex-fixed income guy as well, which means I'm always looking for the downside risk. The downside drivers, as I said, I put in bold up here, the global monetary policy tightening. It's not just the United States, it's the Bank of England, it's the European Central Bank around the world that are pulling the punch bowl because they're seeing inflation as well. There are other things happening, geopolitical risk, very hard to handicap what might happen, what might not, because they're backroom deals. I generally think for investors to protect yourselves from what might and might not happen, but don't try and predict the ways of geopolitical risk because it's hard for us to fundamentally analyze that. We do see supply chain problems that are persistent and longer than originally expected. Though we just came through the US holiday and Chinese New Year, after which maybe we see a little bit of relaxation of some of the supply chain troubles from shipping, hopefully as Omicron works its way through and starts to become less of a concern than the labor supply and demand, starts to become a little bit less of a supply chain problem as well. Midterm elections are coming up. It's looking more and more like we'll have less concern for constraining economic growth from higher taxes, as well as on the other side of that, maybe less fiscal impulse from that. Moving forward some, if you've heard me talk about the virtuous and at times vicious cycle before, it's a consistent framework that we look at that really starts with confidence. Am I confident that I can walk across the street and get a job, get a raise? Confident that I don't have a concern around my income level? Then I buy those discretionary goods, the new red car, the fancy toys for my kids, in which case that's consumer spending. And when we see consumer spending strong or strengthening, then of course companies go buy more machines to make more of the widgets. And as they do that, they hire people to man the machines, to make the widgets, and people to manage the people. Those are jobs, and more demand for jobs at the same supply of the workforce means wages go higher. We're seeing all of this in this virtuous cycle now. Looking forward, I do an analysis on each of those pieces of the economic cycle of what's going right, what might be going wrong. Consumer confidence has risen strongly coming out of the March 2020 COVID crisis initially. We're back at very good levels of consumer confidence. Consumer spending is in a good spot. On non-discretionary, your washing machine, your home upgrades, we're back to above pre-COVID levels. On discretionary spending, we're not yet, but it has been rising strongly. And this big build of $2.5 trillion of consumer savings over the last 20 months is something we think will get deployed into consumption and discretionary consumption. So we see positivity there. Unemployment, I just changed this chart from saying that it's coming down strongly to it's truly a tailwind now. The unemployment rate is low. Wages are rising pretty dramatically in many places. So this is for the cycle, this is generally positive for consumption. Now we'll watch on balance sheets and companies that are having to spend more in employment cost, how much that impacts the economy. But as of now for consumption, this is positive. All this means capital expenditures are prospectively rising as well. Notably, we see companies that are starting to finally upgrade machinery that is some of the oldest age of machinery on balance sheets in the last 30 years. We're seeing that relax. We're seeing companies that are now deploying into new technologies to capture new consumption patterns. A concern that we have is, are we in a wage price spiral a la the 1970s, early 1980s? That is a concern. This is inflation. As wages go up, you have more money and you can potentially buy more goods. We have supply chain problems that are concurrent. And are we seeing concerns around inflation that will be persistent because of this spiral? This remains to be seen as of now, but it is certainly something that the Fed is observing. And one reason why we're talking about rising rates this year, because we do see elevated inflation for a medium-term period. We think it will come off as we start to see some of the relaxation of the supply chain, the labor demand, and the inventory build that companies have done because of that. They'll start to bleed off their inventory. So there are some deflationary forces that will keep us from going over the hilt in too much inflation. We do a lot of analysis, of course. You know Westwood as a fundamental investor. We are talking to CFOs and CEOs about the state of their business, looking and seeing exactly what they're saying about the forward market environment. I often look at the Duke CFO survey. The Duke CFO survey is a survey of 500 CFOs and CEOs around America of large companies, and they're directly saying, what do they think about the environment going forward? Where are they going to be spending? What are their major concerns? Here I just put their major concerns, and no surprise, labor supply, especially high quality labor supply, cost pressures and inflation. The other side of wages going up and us feeling good about spending is that companies feel that on their bottom line, that have people they need to pay more. Can they pass that margin pressure through to goods? That remains to be seen, but certainly it's a concern for CEOs around America that are looking and ensuring that they can have pass-through cost. Looking a little bit further into this, we do something every quarterly earnings cycle called the Mosaic, where our analysts are, of course, directly digging into the minutia of individual company statements, of where their concerns are, where the opportunities are. As we're looking for fundamental opportunities, I pulled some of that out just to highlight what companies are saying. Real estate company, 10 to 20% increase in wages. We see more in some of the services companies. This is extraordinary what we're seeing, and not something that we have seen in many of our lifetimes. Difficult to hire. We've seen a transformation of the workforce. I think this is one of the supply chain issues. Of course, by COVID, here we are presenting on electronic as opposed to me walking around on a stage. That's very different, and that's something that we were years away from before this happened. So it's pulled forward some need for expertise, some need for transition, and we see companies that are experiencing the need for that and difficulty hiring the right skill set people, which also means that's a confluence with wages going up. So labor inflation, that is some trouble. We're hearing that. At the same time, we're getting benefits that are having to go up. It's harder to attract employees. I tell this anecdotal thing of when I started with JP Morgan back in the 90s. I felt like there was, we went through this during the late 90s where they were subsidizing all of your lunches because they needed to attract more employees. Not very good for my own health. But as we started to get to 1999 and the market went down, they went to half subsidies. And then around 2000, they cut all subsidies. It's cyclical as far as inflation, benefits, wages as well. Interesting to observe what we're going through, but it's all across. The supply chain, we're hearing that it remains a challenge. One of those key areas, of course, is in microchips. They're in everything now. They're, absolutely through cars. They are through just about every device that we have in our household. And we have a dearth of the availability of microchips. And so what it's doing is it's causing a supply chain problem. It's causing a supply chain problem for new cars coming across that have all the new technology, but they can't deliver all of that because they don't have enough. Tesla opined on that, and directly looking at that company in general, of course, they're very technology forward. We do see a relaxation of that coming in somewhat the end of this year in 2023 as we see more factories. The housing market is something very topical for us all. It has had an extraordinary run. Supply is still very low in the housing market. Supply and availability, if you just Zillow around your area and say, how many houses are for sale? Not many is the answer. And when there's low supply and reasonable demand, then of course prices will continue rising. One of the concerns of the housing market is that mortgage rates will rise. As mortgage rates rise, that makes it more costly, of course, to have a mortgage. So the same price of house becomes more costly for those people that are buying on mortgage, which is the vast majority of home buyers. Though mortgage rates rising from a low base as interest rates rise could be concerning for housing markets. I think it's unlikely we're going to feel too much pain from that in the short term, simply because supply is very low. And just basic economics says while supply is low and demand remains the same to rising, then we're going to see rising house prices. Valuations, just brought equity market valuations, another topical thing. You see on CNBC every day how we are at elevated valuations. Generally, investors are paying more per unit of earnings than many times in history. Can this be supported is a big question. Right now, the S&P 500 is trading above 20 times price to earnings multiple at a low rate, which we are still at a low rate. And even if we rise rates 4 times this year, we're still at a historically low interest rate that will be supportive, given that we have the ability to maintain margins for companies, that we have pass through of this inflationary response that they will see, number one. And number two, that we have corporate earnings continue to come in strong. So I talked a little bit about the $2.5 trillion that consumers have built up on their savings, on their balance sheet, because of concerns around spending, number one, around the wealth effect of markets going up. Savings rates went up considerably. So this $2.5 trillion coming back out potentially means strong consumption, which leads to that virtuous cycle of good corporate earnings that will need to be supportive in 2022 for us to remain at a high multiple. We think that is possible for us to remain at a high multiple. We don't see it going further from where we are now. I think something also very interesting to mention out of this is that the high multiple that, as I say, you see on CNBC talking about, gosh, valuations are high. We've had a 13-year run with one down year of 16% average returns. Well, one thing that we have is tech is now almost 30% of the S&P 500 index, and technology, of course, is a higher growth area. It generates a higher price to earnings multiple because we have a higher expectation of more generation of cash flows in the future, and because of that, it has a higher multiple, and it's 30% of the index, almost 30% of the index. And of course, historically, it's interesting to look at when sectors get to be around 30% of the index, they are due for a correction. Does that mean we're going to prospectively see a correction? I think unlikely in the near term. There's a reason why technology has transformed into a larger portion of the economy. But when we look back to the energy bubble in the 90s, we see that in the early part of the century, it was up at 30% and came off considerably. Energy is now a sub 5% portion of the index. We look back at areas like the financial bubble, same thing that we saw there, which is it potentially comes off considerably more. Technology is strong. We think that continues for part of the economy, but it also means that we're going to have a higher price to earnings multiple. Something we're also looking at, of course, on the multi-asset side is how much bond exposure do you hold? How much interest rate sensitivity do you have in your portfolio? Now, where can you find good, strong income without worrying too much about rising interest rates? When interest rates go up, bond prices go down. That's something that, of course, affects the capital appreciation on your portfolio, even as you have income. And it's noted right now that the S&P 500 is generating pretty strong returns just from income relative to bonds. So many investors will find it more attractive to find those sectors which are alternative-oriented income that are not impacted negatively from bond prices dropping, from the possibility of interest rates rising. And so that's something we are taking advantage of significantly, is finding alternative sources of income that as bond prices go down because interest rates are rising, we have less concern. We look at a lot of high frequency indicators as well. What we're trying to gain from this is we are looking to gain insight, not just into the past data, but similar to our Mosaic that we're digging into individual statements from companies. What are we hearing boots on the ground at the very moment that we are looking at this? Just some of those pieces of data are hotel occupancy. Hotel occupancy, we're back at near pre-COVID levels. We're in a pretty good level. We've seen some of that come off as we go through the gyrations of new variants and virus scares, but we are generally back to pre-COVID levels. If we look at transit, on the lower right-hand side, this is people taking the New York City subway, or the purple people mover out in California. It's coming back significantly as well. It's not pre-COVID levels, and I think what it's ascribed to now is less concern about hopping back on the subway, and it's it's showing what the new environment looks like. We're a little bit more work from home. We're a little bit more disseminated in our workforce than we were in the past. And that will persist for some time. And this is something we'll look for. We'll look for new areas of opportunity because the environment has changed. I think some of the new stuff that's not on here is next weekend we have the Super Bowl. Super Bowl ads are up 10% this year. That's $30 million for a 10-second slot. It's extraordinary. What are we being told by companies in this that are spending that much ad spending for a Super Bowl commercial? We're being told several things. Number one, that they are seeing inflation, of course, that there's more demand. They're also saying that they expect more sales from advertising in the Super Bowl. I'll be interested to see what the specific ads are, what we're seeing advertised. I generally think technologies like Teams and Zoom that allow us to communicate electronically, they probably saved themselves 3 or 4 Super Bowl commercials by the COVID crisis. They needed to educate a consumer. Instead, innovation was driven by necessity. And here we are, it's pulled forward the adoption of that. So we see more of that. Of course, Amazon Prime just raised their prices by 17%. We see the inflation everywhere, and it will start to roll through significantly. And these are contemporaneous indicators that we're getting of number one, inflation, but also good prospective economic activity. Inflation expectations, the market gives us an idea in many areas of what's expected. The market tells us how many hikes the central bank is prospectively going to do by a consensus. It's a voting machine. The same thing goes for inflation. The average inflation rate priced right now by the market is around 2.8%. And looking at that, that makes you question. So we're talking, we saw a print at the earlier portion of this year that was 7% annualized inflation. That is going to come down significantly from where we are. We'll remain elevated above 2%, but the market is saying that for some time we'll have an elevated inflation, but not hyperinflation. Moving forward a little bit, as I said, one of the key points and things you should take away from this presentation is the Fed is pulling the punch bowl. The Fed is going to be hiking rates. What happens when the Fed hikes rates? You see the bars that go up, the big bars, are recessionary periods. The smaller graph shows the actual base rate by the central bank. And what that tells us is, guess what? When the central bank starts hiking rates, almost always what follows is a recession at some point or a drawdown in economic activity, but not immediately, and certainly not at the interest rates where we are right now. So at the very end, we drew a line just to show where right now we're priced to go on interest rates, and it's still well below where we have been in the past that has led to a near-term recession. So for the coming year, we don't believe that the activity is going to experience a major drawdown for many reasons. We feel that the environment is one where we'll see consumption patterns do well and drive corporate earnings. We don't see extraordinary rise in equity markets, but we do see positive absolute returns in equity markets. We are nervous on bond valuations, but it's good for investors to hold some degree of bond exposure for the insurance that you have, that should we experience a downturn, then bond prices will rise. But generally, we are underweight that exposure relative to our strategic allocation. Looking a little forward, high yield defaults are something that we monitor. This is financial conditions, as Porter said at the very beginning. We don't see that rising dramatically. The Fed just had its toolbox wide open, supporting the market, buying high yield bonds on the balance sheet of the central bank. That is something that helps keep valuations low, keeps default rates low. So we are so confident for the compensation that we receive there for corporate bonds. Bitcoin, I think at the end, it's good to mention because this is a new paradigm, transformative for us. Do we believe Bitcoin is going to continue rising? I think it has potential to, but it is still very early in its phase. It's still very volatile relative to other stores of value, if that's what you consider it. Gold is a store of value that has been around for thousands of years. Now, I put together this quick analysis that says the adoption of Bitcoin or Bitcoin as a blockchain implementation has been way quicker of course, than gold. And how much would it take for us if it's a store of value, if it is a place that you put your assets such that they remain safe from inflation or systematic risk in markets or geopolitical risk? How much would it take for you to shift out of gold, out of productive real estate, out of other stores of value? The answer is not much. On the order of 10% out of gold and some other assets, and we have $100,000 on a Bitcoin price. Does that mean I believe it will get there in the near future? I think it's too early to tell. I think there's not enough data. There's not enough correlation yet between inflation protection and Bitcoin. Bitcoin has been rising and falling with general markets, which means as of now, it's not serving as a store of value. This is thinking way forward. I think retail investors should be very careful about considering this in their portfolio unless they're willing to weather a lot of volatility. We put together, of course, our capital markets outlook, which has the three main scenarios. The three main scenarios are how we think about the operating environment. And then, of course, we need to be cognizant of, well, what happens if we go this way and things appreciate significantly? Or, of course, the downside case. The broad general case is that, yes, we expect 4 rate hikes this year. The market right now expects, or prices, as I said earlier, 5.3 rate hikes. That is more than 125 basis point hike every quarterly meeting. Yes, that could happen, but I think the equity markets are somewhat of a pressure valve. So we see 4 rate hikes this year. We see strong equity markets, but on absolute returns, a little bit less than consensus. We think investors should remain involved, but at the same time, cognizant of where the central bank is going. And if they go too far, then there's further concern. I'll stop there. I appreciate any questions that you follow up with. Certainly our team will help answer them. I look forward to the answers on the survey, and we'll be watching to see who wins the prize. Thanks for your time. Enjoy your day.